In a lot of our content, we're always explaining how you can use cash value banking or the infinite banking to build wealth. Now, one thing we haven't spent much time on is what is the exit strategy and how does turning your life insurance into income compare to using more of the typical financial planning tools. That's what we're going to cover today. Before we go into some numbers, I just want to talk a little bit of a theory. I call this concept your financial climb. And when you are working, you are trying to accumulate assets. And at some point, you're going to hit the peak of the mountain and you're going to hit retirement. What happens is now everything changes because you're no longer accumulating. You're now starting to withdraw. One problem people have is they focus so much on the accumulation period of just trying to accumulate more assets. My question is, what are you trying to accomplish? Are you trying to get to the peak of the mountain the first or the fastest? Or are you trying to be able to walk safely down the mountain? And using the analogy with a mountain, if you were going to hire a guide and buy equipment, would you use it only to get to the top of the mountain? And then your guide saying, okay, you're here, you are on your own, and you don't have the equipment to safely climb down? If your goal is to safely climb down your financial climb, we need to start using a guide, which is like a strategy. In this case is the infinite banking concept. And we need to start using packing your bags or equipment, which is cash value life insurance. Now let's focus here that we are at the peak of the mountain. So the question is, okay, I accumulated up all these assets. How do I know how much I can safely take out and comfortably feel that I will not go bankrupt? Fortunately, the industry has answered that question. What the financial industry has done is they ran all sorts of scenarios with different sorts of portfolios and said, for example, if you use an 8% withdrawal rate, now a withdrawal rate is not earnings rate, it's what percentage you could withdraw. Thus, if you had $1 million and you withdraw $80,000 a year, that's 8%. At 30 years, you would have about an 8% chance that you're going to have $1 left, which means there's over a 90% chance that you're going to be bankrupt. What typical financial planners will say is they use the 4% rule. At this point, at 30 years, you only have maybe about a 85% chance that you're going to have $1 left. A key thing to note here is, if you can see in the video, when is this written? This was written in 2006. Do you think things have changed since 2006? In fact, the guy who came up with the 4% rule has stated the 4% rule no longer works. Some people are saying the withdrawal rate should be 2.5. Some are saying 3.5. Some are saying 3. So let's take a look at one case. I like to say here that Infinite Wealth Consultants, that we do the math. So what we did is we contacted one of the insurance companies on one of the policies my clients have and asked them how much money they could take out from 70 to 100 years old. They came back out with they could take out $57.95. So let's compare this to using typical financial planning. How much would we have to build up in net worth or assets to safely produce $57.95? Now, if we use the 3% rule, divide by 0.03, we have $193,000. So what that means we need to have a net worth of $193 to be able to produce that amount of income. What I did in this example, I took the actual deposits or premiums that this client took when we started when she was 51 until she's 70. So here's the question. How much do I need to earn every single year to have $193,000? Right now we're at 71. So let's take a look. Let's say 4%. We only have 119. Let's do 5, 6, 7, getting close, 8, a little bit more, so 7.5. So we'd have to earn 7.5% every single year. On that point, my first question is that even possible? Let's kind of take a quick little look here. Let's say you had $100,000. And if I could guarantee you that you would earn an average of 25% a year, would you be interested? Well, hopefully, of course you would. Now, in this case, the first year, we did awesome. We doubled our money at 100%. But then the next year, we didn't do so well. We lost 50%. Then in year 3, we made another 100, but then in year 4, we lost again. So we started with 100 and we ended with 100. What is our average rate of return? The average rate of return technically is 25%. Wall Street is able to say that because averages are just the average of the total of the earnings rates. In my eyes, the way that we do it, the way we do the math, this is a 0% return. So thus, we want to focus not on the average, on the actual rate of return. Now let's take this one step further. And do most people save in a lump sum, like $100,000 at once, or are they saving systematically? Let's say that you save $10,000 a year. So this first year we put in 100,000, we doubled our money, we have 200. Then the second year we put in 100, but we lost 50%. So we lost 150. So we're down to $150,000. Then in year 3 we put in 100, brings us up to 250. Then we double our money. So awesome, we're up to 500. But unfortunately in year 4, we lost 50% again. So we're down with 300. So here's the question. What is your average rate of return? It's still 25% because we did not adjust the earnings rate. But again, the way that we do the math is you actually lost 11%. The point I'm trying to make is that it is very difficult to earn every single year inside the stock market. You're going to have some ups and you are going to have some downs. So you need to take a look at what's the actual return and not focus on the average. In this scenario, a lot of times people are comparing life insurance to an investment. I'd first say life insurance is not an investment. This is a savings vehicle. We're not tied to the market. We're not tied to loss. These are guarantees. These are backed by insurance companies that are over 100 years or older. Stock market is backed by a sheet of paper. So using typical financial planning rules, you'd have to earn 7.5% every single year just to equal what this woman's policy did. But I'm missing something. If we were to invest in, say, a mutual fund or something in the stock market, do financial planners and Wall Street are they non-for-profit? let's be modest and say that the fees to the financial planner and the mutual fund fees and all the other hidden fees are 2%. Now it's 7.5%. We only have 140,000, which means we need to earn more. So let's go to 8. Nope. 9%, still not there. Let me bring, because if you remember, we were trying to get to 193. So let's look at 10. At 10, we're a little bit too high, so let's do 9.9. Okay, so investing in typical financial planning tools and strategies, your same amount of deposits would have to earn 9.9% every single year without a down year. I almost forgot one more thing. What's another thing that's different between life insurance, another advantage life insurance has as opposed to a typical investment? It's tax-free. This client's personal situation, she's in the 28% tax bracket. So now we're going to need to earn more than 9.9. Let's say 11. All right. So let's see, 11.5. So you'd have to earn 11.2% just to equal the amount of income that you would have in retirement. The moral of the story is that when we're looking at our financial climb, let's not focus so much on our net worth. What we need to focus on is income. Income is what's going to be able to put food on the table, to pay for our medical bills, and to pay for spoiling the grandkids. Hope this was of some value. You have a fantastic day.